The world doesn't run on money anymore. It runs on promises. Promises to pay later. Promises to grow fast enough. Promises that tomorrow will be bigger than today. Now picture this. Every second, somewhere on Earth, a clock is ticking. Not a dramatic red countdown in a bunker, a quieter one. Inside government budgets, bond markets, central banks. That clock is global debt. And it's bigger than most people realize. Right now, total global debt, governments, companies, households, is more than 3 times the size of the entire world economy. Trillions stacked on trillions. Numbers so large they stop feeling real. But the consequences are very real. Because debt is time travel from money. You spend tomorrow's income today. That works beautifully until tomorrow arrives. This matters now because the bill is getting heavier at the exact moment growth is getting harder. Populations are aging, productivity gains are slowing. Geopolitical tensions are rising. Yet borrowing continues, like the music in a game of financial musical chairs that nobody wants to stop. So how did we get here? Step 1. Debt became normal. After World War II, borrowing helped rebuild countries. Roads, power grids, schools. Debt funded real growth. Economies expanded faster than what they owed. The system worked. Step 2. Debt became a tool. In recessions, governments borrowed to stimulate demand. Central banks cut rates to make borrowing cheaper. Each crisis trained markets to expect rescue. The safety net grew. Step 3. Debt became the system. After the 2008 financial crisis, interest rates fell to near zero across much of the world. Money was cheap, almost free. Governments borrowed more. Companies borrowed to buy back shares. Households borrowed for homes, education, lifestyles. When the pandemic hit, borrowing exploded again. Emergency spending on a scale never seen in peacetime. Here's the uncomfortable math. Debt grows with interest. Economies grow with productivity and population. When debt grows faster than income, the gap widens quietly. Like a credit card balance that looks fine until the interest line catches your eye. For years, low interest rates hid the problem. If you owe a lot but pay almost nothing to service it, the pressure feels manageable. But rates don't stay low forever. Now they're rising. And that changes everything. Governments that borrowed at 1% now roll over debt at 4% or 5%. On trillions of dollars, that difference is massive. More tax money goes to interest, not services. Less for healthcare, infrastructure, education. Voters don't cheer for interest payments. They don't see them. They just feel cuts. This is where the trap tightens. Countries can respond in only a few ways. None are painless. Option 1. Grow out of it. If the economy expands fast enough, the debt burden shrinks relative to income. But sustained high growth is rare, especially in aging, slower-moving economies. Option 2. Austerity. Spend less, raise taxes, balance budgets. On paper, this sounds responsible. In practice, it slows growth, engages voters, and can spark political instability. History shows governments often lose elections before they fix debt. Option 3. Inflate it away. If prices rise faster than debt, the real value of what's owed falls. Savers lose purchasing power. Borrowers win. This is subtle. No official announcement. Just money quietly worth less each year. Option 4. Financial repression. Keep interest rates below inflation. Encourage institutions to hold government debt. Gently steer the system so savings fund public borrowing. It's less dramatic than default. More gradual. But still a transfer of wealth. And then there's the word nobody likes. Default, restructuring, delaying payments, changing terms. It happens more often than people think, just usually in smaller or weaker economies. The idea that major countries are immune is comforting. History suggests otherwise. Here's the irony. Debt isn't evil. It built modern economies. The problem is scale. When too much of the future is already spoken for, flexibility disappears. Every shock, a war, a pandemic, a banking crisis, hits a system already stretched. This is why markets react so sharply to interest rate changes now. It's not just about inflation. It is about the entire debt structure sitting on top of those rates like a skyscraper on adjustable pillars. Turn the dial too far and something cracks. Meanwhile, there's a strange calm on the surface. Life goes on. Stocks trade. People shop. Governments function. Debt crises rarely begin with sirens. They begin with small shifts. A bond auction that goes poorly, a currency that weakens. Investors asking for a bit more yield, then a bit more. Confidence is the invisible glue. As long as lenders believe they'll be repaid in money that still holds value, the system rolls forward. When that belief wobbles, borrowing costs jump. That makes debt harder to manage, which weakens confidence further. A loop. So can nations escape? Some will try to innovate their way out. New technologies, productivity booms. Some will slowly erode debt through inflation. Some will quietly restructure. Most will likely mix all of the above, spreading the pain so no single moment feels like a collapse. The real risk isn't a single global explosion. It's a long, uneven squeeze. Slower growth. Higher taxes. More financial volatility. A world where policy decisions are less about opportunity and more about managing yesterday's obligations. For individuals, this shapes everything. Interest rates, job markets, asset prices, currency stability. The background math of national debt becomes the foreground of personal finance. Because when governments are financially constrained, someone else eventually absorbs the constraint. Through taxes, inflation, reduced services, or lower returns. The global debt clock isn't a movie-style bomb with a neat red timer. It's more like a pressure system, valves opening and closing. Steam released here, tightened there, always managed. Never fully solved. And as more of the future gets pre-spent, the question isn't just whether nations can pay what they owe. It's this. In a world built on promises about tomorrow, what happens if tomorrow stops growing fast enough to keep them?